India has become the first major stock market to erase all the losses incurred after the April 2nd reciprocal tariff declaration. More important, the Sensex and Nifty are now above the pre-April 2nd low levels. Meanwhile, the full-blown tariff war between the US and China continues and is getting worse. What are the implications for investors? Welcome to Geojit Spotlight. India is outperforming other large markets. This is important. Sensex, which had crashed to 73,137 on April 7th in the global market crash, has recovered to around 77,000 levels. This is higher than the pre-reciprocal tariff level. Most other large markets are below their pre-April 2nd levels. So, why is India outperforming? Two reasons are important. One, India will be one of the least impacted economies, least impacted from Trump's reciprocal tariffs. India's exports to US is only around 2% of our GDP. We are a domestic consumption-driven economy. So our GDP growth will be impacted less than others. Of course, when global growth declines, India's GDP also will decline. But even in an unfavorable scenario, India's growth will be around 6% in FI26. The market is discounting this. Second, and this is more important, India has initiated talks for a bilateral trade agreement with the US. In fact, we initiated this trade talks much before the reciprocal tariffs. The market expectation is that India and US may reach an agreement on trade in 90 days or around that time. The US Treasury Secretary Scott Bessent has recently declared, I quote, "The first 4 deals that we will be making will be with our allies, UK, Japan, South Korea and India." This is hugely important. US considers India one among the 4 important allies in the world. The market will slowly start discounting this, or perhaps it has already started discounting this, facilitating India's market outperformance. What we need now is earnings growth. After 20% earnings growth during the 3-year period, FY22 to 24, FY25 earnings growth declined to 5%. In the absence of earnings growth, the rally cannot sustain. Market is not cheap. Nifty is now trading at around 20 times estimated financial year 26 earnings. This is higher than the long-term average. Investors should take note of an important trend in the market, an important trend that is happening now. Nifty is down around 11% from the 2024 September peak. Year till date return is negative at around 1.6%. Yet, many stocks are at 52-week highs and some are at all-time highs. All these stocks are domestic consumption-driven stocks in financials, aviation, telecom, cement, healthcare, and selectively in autos. Through our previous videos, we have been advising clients to focus on domestic consumption themes. Now this is getting reflected in the market. Look at the market performance of domestic consumption stocks like Bharti Airtel, Interglobe Aviation, leading private sector banks, blue chips like HDFC Bank, ICICI Bank, Kotak Bank, cement stocks like Shree Cement, autos like Eicher Motors, etc. This relative strength of domestic consumption themes and relative weakness of externally linked sectors like IT is likely to continue. Another significant trend in the market is the FIIs turning buyers. In this full-blown trade war between US and China, both these economies, the largest and the second largest, will be the hardest hit economies. US might tip into a recession, or at best, the growth in 2025 for US will be less than 1%. China's growth is projected at around 3.5% in these crisis times. So India's outperformance in GDP growth at 6% will lead to outperformance in the market also. In brief, FIIs are likely to continue investing in India. Their favorite stocks like the leading banking names and other domestic consumption stocks will attract more buying despite the uncertainty in global markets. Investors should keep in mind the fact that these are highly uncertain times. Unprecedented chaotic times. Therefore, always exercise caution, abundant caution. However, it is important to learn from market history that crises are not the time to panic and leave the market. Experience has taught us that particularly stopping SIPs during crisis would be a very bad investment strategy. Remaining invested, continuing to make calibrated, systematic investment and waiting with lots of patience will be the ideal investment strategy in these difficult times.